Number one, it was unable to generate the revenue. Then at least if you are still unable to generate the revenue and your cost is still fine, it's still easy, right? Then you realize that the costs were way too under forecasted, right? And it was hard to balance things up. So he had to go and be borrowing money, borrowing loan to pay investors. They've signed the agreement and the whole thing, right? So let's take it step by step. So now let me ask you, method one and method two. I think there's a name for it. I'm sure we have some of our economics guy in the house. What is the name of this method one and what do we call the name of the second method? So as I said, you can make use of the chat box as well. If you prefer to talk, you can as well unmute our mic. What do we call the method one? What is the name of the second method? Our economics guys in the house, our research analysts. So you can type in the chat box. If you prefer to also talk, you can just as well click on your and to. Adeolu is saying the method two is cost of equity. Okay, so so maybe I should just put the formula again so that we'll see that. So for the first formula, right? Let me put the formula. Okay, so I think it would be better to put it here. This formula is saying for the method one, we use 1 plus, okay, so 1, which is our base year, multiplied by 1 plus our growth, which is our inflation, right? Then the second method is saying 1 plus our growth, then raised to what? Raised to our what? Our period minus 1. Okay, so M1 is nominal and the M2 is real. Okay, thank you for that, Marco. Do we agree? Do we agree? Do we agree? M1 is incremental costs. Okay, I think most of them are incremental, I believe so. Right? So what do we call this method one? Marco believe it is nominal, method one, and method two is real. Do we agree? You can as well unmute your mic as well. So this will be very interactive. What do we think? Which one is real? Which one is nominal? Okay, so Dix said I agree with Marco. Okay. Which one do you think is real? Which one is nominal? All right, Sadiq is saying, yes, method two kind of considers discounting factor. Okay, discounting factor, all right? So he's saying this one is nominal, right? And this one is real. Do we all agree? Do we all agree? If you want to also, you can as well just use our hand to, if you prefer to just say something. Let's have that discussion. Let's have that discussion. Okay, maybe I should just put it out this way. Which one would you like to use, assuming you are building a model? Yes, let's assume you have these two methods that you can apply, right? Now, let me now ask us, which one would you like to use, assuming you are building a model? And if you take a look at this, so this method one is the same thing as this first method. Yes, this one. So it's saying here 135, here 127, and by year 5 is what's around 174.3. Then the second method is saying, yes, the value today is the same thing today, right? Even though it's still considering the timing. Second period, and by the fifth period is saying 149. Which method would you prefer? Let's have that discussion. So remember, I'm still going to ask us why, and on what basis. So please let's try and chat. Let's make use of the chat box. All right. Which method would you prefer to use, assuming you are building your own model now? And on what basis? On what basis? We have method one, that's more like a nominal. Then we have method two, which is more like a real. Okay, so Sunny said method one that I've incorporated inflation on year compounded basis. Okay, love that. Thank you for that. Let me hear from others. And it's best to use for forecasting. Okay, I love that. So this method one kind of more like a compounding of a thing. think I agree with that. So let me hear from us. 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 Which would you prefer to use, assuming you are building a model, and on what basis? Okay, so method one, preferably in order to be on a safer side, right? When you see the reality, more like you trying to over forecast your costs, right? And other forecast your revenue. All right, so I love that. So please let's share insight. Let's share insight. Let's share insight. Which would you prefer, assuming you are building your own model today? Which of this method would you prefer to use? Okay, so Adeyemi is saying, what would be the effect of using the average of both method? Adeyemi, well, that's another thing, right? But I'm a little bit skeptic as to using the average of both method, if that would make sense. I'm not sure. I'm not sure, right? But that's actually one option. All right. Wasi is telling us to follow the prudency concept of overstating the cost. You can use the method one and avoid unexpected, funny things that can happen. Okay. All right. The truth about it is this. Most time when I'm building my model, I love to build a lot of flexibility into my model. And the question of either to use method one or method two, definitely it is subjective, right? For example, if you have your pricing of your products and you are saying the pricing of your product to be constant for the forecast period, right? What would be the impact if you use any of this method? Now, the real question is, we really cannot answer it now, not until when we build the model and we see how this kind of have impact on our what? On our profitability, right? Because yes, the truth is we are trying to make provision for time value of money, but you also need to understand that it will really not make sense by the time you are overshooting your cost, because definitely it will eat into your profitability and also eat into your cash. You definitely want to be on the safer side as well. So the way I would have approached this if I'm building my home model, let me show us this. So let me delete this. There are some elements that you are really not 100% sure or let me call this our inflation. So let's call this our inflation scenario. And you are trying to incorporate those strategy into it. So here I'm going to create a switch here. So let me just type one here. So what this means is this: whenever I type one here, I want Excel to give us the inflation rates, right? Okay. Oh, I've forgotten. I rename it. So we call this aggressive rates, and then we call this more like a conservative rate. So whenever I type one, I want Excel to give us the aggressive rates, right? It should be applied into our model. And whenever I type two inside here, I want Excel to give us the conservative rate, right? So to make this work very well, I'm just come here and I'll type equal to choose. What is my index number? This is my index number, such that whenever I type one or two here, it just kind of give us the one represent aggressive and the second one represent the conservative. So this comma, my first value, then I'll select the second one, which is what? Which is our in our switch. Let me keep it constant and let me put this as multiple. Then we have this. So which means this is what we definitely fit into our model, right? So if I type 2 here, look at what happened. We have the second conservative method. Now, one interesting thing about this, whenever you are building your model, you also need to consider your users as well. You really don't want them to be coming here and be typing 1 and 2 every time, right? They should have a switch that can also help them to just select maybe the aggressive rate or the conservative rate. So as I said, when you are done with the model, that's when it will be easy for you to test and see, okay, if I'm using the aggressive rates, how will this affect our business cash, right? You can use aggressive rate and you see that your business will be at loss for the period. You can use the conservative and you see that your business is showing positive profit for all the years. So you're just trying to see how will this affect my business. There are a lot of things that can happen as well. So I'm going to create a switch. I don't want my user to be typing 1 and 2 here. I want them to have a switch that they can use. So I believe this is also part of our basic Excel thing. So I'll go to my developer tab and I'll click on insert and select my combo box. Right, so let me create that combo box there, and I will right click it, click on my format control, input range. Where's my input range? This is my aggressive and my conservative. And where's my cell link? So this is my cell link, this cell that's contained the number, and I'll click on my OK. All right, so with this I can select. If they select the aggressive, you see how that's kind of change. If they select the conservative, you see how that's kind of change as well. So instead of my users typing 1, so the here instead of the 2, let me just make the color the same thing with my Excel. Yes, so that's, and I can just put this somewhere around there, so it's easy for them to select aggressive. This, you see how that kind of change. You select the conservative and you also see how that switch affects. So the time you are done, you create a summary dashboard. You have that inflation multiple that they can see. One, how does it also affect the business as a whole? So for this, at least for now, let me just put it on our aggressive rate. Now, how does this now tie into our model? Remember, that is more like the main thing and what we really want to understand. Now, let's assume we are forecasting a business, all right, and we are saying our total cost. So let me just use some random total cost. Let me use my country currency. Yes, all right, and let's put this more like in a million. And we've done our forecast and you're saying, okay, you know what, for the first period, our cost will be something like, we are saying, let's even say, this is more like 45 million, right? I think this should be billion. So maybe I can just change it to, okay, 3 zeros, right? And let me keep this constant. So our total cost for our business for all the years will be this value. Now, what is the impact of our inflation, right? And that's what we want to check. So let me link this and equal to, I just link this to the running inflation multiple, right? And to see this, so this will be more like our adjusted cost, adjusted cost for inflation. And that will be equal to this 45 multiplied by my my inflation multiple. And I can drag that to the right and we have this. Right? Oh, okay, you know what, let me add 500 as well. So let's make it 45 500. Okay, perfect. So which means this will be our what? This will be our costs. So yes, while we are doing our forecast, we are saying yes, 45 500 millions will be our cost and our expenses for the for our business operation as a whole. But what will be the impact of that inflation on it, right? Something of 45, and with the, at least for using the first method is saying 51, then in year 5 is giving us around something 79 million. Now let's have that discussion. Do you think this really makes sense? What do you think about this? What do you think about this? Let's have a discussion. You can click on your answer if you want to share some insight with us, right? How do you think this will affect a business? So you can go ahead. So how do you think this affects a business? Okay, yes, Sadiq, kindly unmute your mic. Yes, Sadiq, you can unmute your mic, please. I believe you
Okay, good
could.
evening.
Yeah, good evening.
So I think for the costs, this is just showing the reality in the market, telling, although it would increase the cost of sales or cost of production for the entrepreneur or the business person, but at the same time, it also reflects what is happening in the market at the moment. So it allows the businessman or the producer to understand and make and impute the inflation into its cost of production in order to know the prices at the end of the day that will sell his product or service at the end of the day.
Okay, all right. Thank you for that. Thank you for that. Thank you for that. So, we are still going to have more discussion on this. But first, before we do that, yes, cost is increasing, cost is increasing. And definitely there should be an impact on our pricing as well. So let me create a pricing inflation here as well. So as I said, most times what we usually do is most times we prefer keeping our pricing constant for the forecast period. So let's say I want to be selling something and I'm saying, okay, we'll be selling, let's say 15 naira per unit, right? So we'll be selling 15 naira per unit here. Should be the main price. It should be the main price. Then let's have our pricing inflation here. Let me put this in our percent. So let's assume we decide that, okay, you know what, our pricing should be constant for the forecast period. And let's put it as, or even if there will be any increments, let's just set everything at 1%. The truth is this, the fact that inflation is actually increasing really does not mean that price of products also increase as such, right? Because there are a whole lot of things that affect your pricing and your product sales, right? Number one, you need to consider your competitors. You don't want to increase your pricing, whereas or your competitors just kind of keep the same thing, right? Also, you also need to understand your customer, right? Purchasing power, the demand, and the whole thing that affects it as a whole. Yes, truly, price can increase. I'm not saying price cannot increase, but not in the same response to how our cost increased. Right, and one thing that is even common now is what we call, there's something we call string inflation. So instead of company to increase their price, they will keep the price constant. Then they will try and reduce maybe the quality or the quantity, just to be able to do what, to still keep the price constant. Because yes, inflation is really eating into your cost, and there's at least there will be a corresponding response in your pricing. And even if there's no corresponding effects in your pricing, there will be a way the company needs to manage their cost. And these are all the things that as a startup business they also need to make provision for when they are doing their strategy plan and things like that. So let's assume our pricing is being constant at 1%, right? So let me create my inflation multiple here, right? So which method should we use? Which of the method? Okay, so let's use the conservative method. So 1 plus our inflation rate, then raised to power 1, the period, right? The period that we have up here, minus 1. So let me put this multiple. So which means, okay, yes, Pasoni is also giving us some other insights, right? There are lots of consideration, your ability to pass on cost or not, yes, right? Elasticity of your product, your power over customers, different things. And you are, whenever you are building your model, these are the things, these are how you should think about it to be everything and is not a necessity, and that those are the things that most businesses are currently facing now. So here we just said, let's keep everything constant, right? So let me call this our adjusted price. And I'm saying equal to this multiplied by our what? Our price multiple. So we are saying this is our price. This is our price will be increasing. And look at how our cost is increasing. So you can see that definitely they are really not growing the same way, right? So let's have our quantity. Let's have our quantity here. So let's just have some random quantity. Let's say, well, okay, so units to be sold. So let's say for at least, maybe they will start with 1,000 units, right, for the period. You should be able to sell the 1,000, and let's say the growth, let's just have a random, maybe, so let me put this in input and also in percent. So let's assume this period, just some random percent, 12.5, let's say 15, 10.5, just some random value, then maybe 16.8. Let's see that. And let me increase this production, this and we are saying this is what we are going to have. Now let's look at, as I said, we want to look at two business case, right? And let's so aggressive, remember that's what we are using. If we decide to work with the conservative, so now you are seeing how this kind of have impact on the business, right? Aggressive is saying the business will be at a loss for the first 2 years. Then, so let me even copy this. Let me copy this, let me paste it here. So we know that this is under aggressive profits, right? This is what we have. But change this back to the conservative. Look at what we have. So conservative profits. Now, let's assume you are a business owner. Which one would you prefer to see? Is it the profits on aggressive or the profits on conservative? Let's have that discussion. So please, you can unmute your mic as well. Let's give us some insights. Which would you prefer? The aggressive. Okay, yes. So you can also unmute your mic and tell us why, and on what basis. Right. So on our aggressive, you can see what the business is showing us. And on our conservative, this is what we are seeing. So which would you prefer, aggressive or the conservative? Okay, okay, all right. People said they can't unmute. Please, you can just click on your hand to first. Then, okay, all right. Okay, all right. It's okay because some people, okay. It's because of people coming in. Okay, all right. Yeah, Joseph. Okay, yes. Oluwanifemi.
Okay. Good evening, everybody.
Yeah,
So,
good evening.
you said what rate would a business owner?
Yes, which one would you
right?
prefer? Yes, exactly.
Business owner. Well, as a business owner, I'll prefer the conservative because it gives me more profit.
I love that.
As an accountant or as a financier, for example, as a bank, I'll take the aggressive because it gives me the worst case scenario.
I love that. I love that. Thank you for that. Thank you for that. Let me hear from someone else. Anyone else want to give us insights? All right. Thank you for that. I love that. Okay. Yes, Akinola. Can you unmute your mic? Yes. Good evening.
System. Can you hear me?
Okay, yes, I can hear you now.
Yeah, so for me as a business owner, I would like to see the aggressive aspect. And the reason is that I know that the aggressive aspect is more strict, when you compare it to the conservative. So I will try to look for what are the things like I can do maybe to reduce my costs, just to ensure that if I consider the aggressive aspect of it, is there anything I can do to reduce that cost? So if I can do anything to reduce my cost using the aggressive, I know that profitability will improve. And as such, if worse comes to worse, I will still likely be
For that. Thank you for that. Yeah, let me hear from so oh yes, I don't know, your voice was going off and on. Thank you for
Yes,
that
there was a
insight.
call that coming.
Oh, okay, all right, all right. So kindly go ahead, sir.
Yeah. Yeah, as I was saying, as for me, as a business owner, I will go for the aggressive. If what case comes, and okay, at the end of the day, I'll still make profits, my business. But if I'm to go for an investors that want to put money into my business, I'll go for the conservative, at least to show them that, okay, this business, this is how the profit will come from the beginning of the year to the fifth year. That's my own aspect.
Okay, I love that. Thank you so much. Thank you everyone for that beautiful contribution. Now, in fact, I'm supposed to have had, okay, Emmanuel. Yeah, let me hear from Emmanuel.
Okay, good day, everyone.
Yes, Emmanuel.
To me, I feel since it's a startup and still new, and you're supposed to face a lot of uncertainty in future, because a new business we can't actually predict all from the onset. So I think the aggressive will be better because it shows us like the worst case scenario. Probably we might not get that much losses, but let's say it does come to pass, like what's come to us, that we embrace it, like we'll be ready for it. So that's why I think for a new business and a startup, the aggressive will be better.
Okay, I love that. Thank you for that. Yes, Joshua Joseph. Want to give us your own insight as well?
Okay, thank you. So, my opinion is that for a business owner that is presenting this maybe to an investor, business owner would rather go for the conservative because all what investors want is how much am I getting in return. But if you are going for a loan, probably to the bank, it will be best to present aggressive own so you can delay your payment period.
Perfect. Thank you for that. Thank you for that. Now let's add one more clause to this. Let's add one more clause to this. Right. So let me create that clause here. Right. So let's assume this is, as I said, we are looking at Mr. A, right, that want to work with conservative, and they're saying, okay, you know what, let there be dividend, let's create some dividend dividend payout ratio, right? And they're saying, okay, you know what, you're going to give us 20%. You'll be giving us 20% of the profits that you make every period, right? So what that means is this equal to, so let me see, whenever we are making profits, right? So yeah, most of the time I don't like using if function in Excel. There are some funny things about if function. So here I will type equal to, let me just use some logic, equal to, if our profit after the year is greater than 0, right? Enter. This will give me true. So true in Excel is the same thing as 1. All right, so if I click on the aggressive, it will give me false. That means we are making loss. So false is the same thing as 0. So let me put it back to conservative, right? Then I will now multiply it by the profits that we have, multiply by what? This our dividend payout ratio. Then I'll keep this constant and I'll press enter. Okay, forgot to close the bracket. So Here. So what Mr. A, what he has done is this: when the guy built the model, they built it on conservative. And in having that discussion with the client, let me sum this together. They're already telling the investors that, you know what, this is the amount that you should be expecting over this 5 years period. Right? This is what you should be expecting over this period. I've actually seen a lot of business owners that, yes, they presented the financials, they agreed and everything. That when the business started, it was the other way around. And they had no option than to go and be borrowing money to settle the business, to settle those investors. Because yes, they've asked you necessary question and you were giving them that clarification that yes, this will definitely what? This will definitely work. Right? You've gone to your investors, you're saying, okay, don't worry, this is what will be, this is what will be. Now let's look at Mr. B. Let me just copy this. Okay, up to this. Let me copy this and let me paste it here. Now let's look at Mr. B. Let's look at Mr. B, right? So let me delete this. So let's assume our revenue is the same thing, right? Revenue is the same thing for both of them. Then the cost, Mr. B decided to work with only the aggressive one. So our total cost multiplied by the aggressive rate. Enter. So that's what we have. So now this is what Mr. B have decided to work with. This is for Mr. B. Now, Mr. B has gone to his own investors and he's telling the investor that, you know what, over this period, this is what you should expect. Right? Yes, I know most times when we build our model, what we usually do is we try to factor in some things so that we make sure that yes, our business model is looking good, is looking profitable over the 5 years and the whole thing. But the reality of it is this: we should we need to face that reality. I major more when it comes to startup, right? That's more like my own area of focus when it comes to financial modeling. And I've been building model for startup organization that they've also been in existence, so maybe for the past 3 years or 4 years. And I can tell you that only few have actually been able to even break even within that 3 years period. And one of the things that really eats into them is that cost. Because now you need to remember that, number one, you are just navigating into the market. It's not always easy, right? In fact, your marketing alone can even eat up all the revenue. And most times, there are some costs, for example, marketing costs that you incur in year one. Maybe the impact of that marketing cost, maybe it will be maybe at the end of year 2 or year 3, that it will start reflecting on the business revenue. Right? And secondly, yes, when you are starting, maybe to have a 5% increase in your revenue might definitely cost you more than you expect, or more than the provision you've actually made. Because yes, if the business is so good, then expect more competitor to come in. Then how do you get to balance that? So it's not a magic. Yes, we try to build model and we're saying, okay, this business over the next 5 years, maybe they will make loss in only year 1, then year 2 up to year 5, everything will be looking good and looking sweet. The reality of it is it does not work like that. And so many business owners, they've actually set themselves up, right? Remember on this first one where we are using conservative, this guy has promised investor that, you know what, I'm going to give you 9.9 million. But these guys are based on this. It's this Mr. B went ahead and told the investor, you know what, this is what will be. And this is what you guys will get. Now, let me ask you, from a perspective of an investor, a reasonable investor, right? Which would you prefer? Which would you prefer? Let's have that discussion. Which would you prefer? This guy is showing you 9.9 with the conservative cost, right? In fact, let's look at the revenue growth. Let's look at the revenue growth here. This divided by this minus 1. They're both showing us the same, right? So, okay, yes, Emmanuel. Will you
Okay,
prefer?
from an investor perspective, I would prefer think the conservative because I'll profit more from that.
You profit more from it, exactly. Right? I love that. Now, most investors too, they are financially literate, right? Most of them know more about this. So you know what? They will take a look at your cost and look at everything and be like, before your business will be able to move from this 16.2 to 11.6 growth in revenue, definitely it will not be a small thing. Yes, the cost is increasing as well, but you might need more than that. So what they will do is, okay, they will ask you, are you sure about this? Do you have the plan? You're telling them this is the strategy and the whole thing and everything. Every strategy you build always have cost implication. You should not forget that, right? Now, you've said that, okay, we've promised this investor 9.9. This other guy is promising this investors 2.62, right? Now, let's even assume everything being equal. You get into the business, and by the time both of them face the reality, they were both faced with the aggressive. Okay, so let me copy. Let me conservative. So this was what the guy promised, right? And then when they got to the reality part of it, they were faced with the aggressive inflation, right? Inflation is one, right? So remember, we are also considering you might be some expenses you did not consider where you were doing your startup and everything. You go to the business, you realize we need to incur this, we need to employ this, we need to do this. So everything just kind of summed together. Now, this is what you promised minus the reality of it. Okay, so this reality, let me say reality minus what you promised. Now, let me ask you, how will this Mr. A be able to get this fund to settle the investors as promised? Let's have that discussion. How do you think this Mr. A will be able to get this negative of 7.8? So how do you think this our Mr. A, how do you think he will be able to get this funding that he has already promised? This was what he showed to the investors, and he believed this will be the reality part of it. And on that, he's saying, oh, you know what? Yes, within these 5 years, I'm going to give you 9.9 million. Then he was faced with the reality, right? Even the first 2 years, he's even struggling to balance up the business because your cost is even way higher than your revenue, and which is the reality of it for most startups. The first 2 or 3 years, they're just that cost it, right? At long run, yes, the revenue will be able to offset those costs, but at the start, this is what they usually face. So as a business owner, for some of us that we decided to go with A, how do you think we can get to balance this 7.8 million? Let me hear from us. Some of us that we chose Mr. A. So remember, you can just click on your hand too, so you can share your own thought with us. Right? This guy only promised 2.162 to be at the safer side. But this guy was working with a conservative and he promised the investors 9.9. Then getting to the reality part of it, first year, second year was still struggling. This guy, Mr. B, already has already factored that into his own. Whereas this guy is showing that my own business will be worth more than, will be getting 19 million in year 5. Why this one is just saying I'm just open up the profit stand, right? So how do you think this Mr. A will be able to settle this? Okay, yes, Chinaza, kindly go ahead.
Hello, good evening, everyone.
Yeah, good evening.
Well, I think like you stated earlier, Mr. A could go borrowing to pay his investors, and he could also sit them down to explain to them how things are turned out, and they could restructure the payment plan so that payments will be made in future years. Thank you.
Okay, all right. Thank you for that. Thank you for that. I love that. Yes. Oh, Sadiq, can you share your own insights? How do you think this man will be able to settle this?
Okay, so first and foremost, I would assume that he's working with equity owners or equity investors. So in terms of equity investors, it is not mandatory that they get dividend. However, they are expecting. So in a situation where it gets to the point where he is not making profits, all he has to do is probably get to meet with his investors because they are worried already. Although they are also aware that it is not like a mandatory thing for a business owner to pay you dividend, but they are expecting. They want to know that this is what my money, this is what my money is doing, this is where my money is, what's the good prospect and all of that. So I believe the Mr. A can sit them down, explain the reason for the discrepancy, if there will be need for him to go borrow that from debt owners, or if there are new strategies in order for him to make up for the reality that he did not initially prepare for. So I think he can work on that.
Okay, all right. Thank you for that. Right, as I said, yes, we have different investors agreements here and there. I agree with you, but we're saying, okay, at least let's say for this, at the point where you are signing the agreements with them, these are not equity investors that you are giving a stake in your business. Yes, for people you are giving a stake in your business, those ones are very, very easy because definitely you are running the business together. The business belongs to you guys, and it's easy for you to see the whole thing. But let's assume this is just an investor that is giving us this money and is saying over the next 5 years, just tell me this is the cash I should be expecting from you, and you've signed that already, right? So let me have 1 or 2 more insights. Yes, Sadiq. Okay, thanks, Sadiq.
Sorry. Good evening.
Yes, good evening.
Okay, according to the scenario that you gave last, I believe this kind of business, Mr. A is ready to fold up his business because the next thing the man should think of is sell his assets and settle them.
I agree with you. Thank you for that, right? I agree with you because now this man is now Mr. A is faced with 2 problems. Number 1 problem of making sure is getting increasing revenue. Then the second problem is now how he's going to get fund to be able to settle these guys. Right? Because automatically this Mr. A will now be put under pressure. Because year 1 is looking like this, year 2 is looking like this. Year 3, yes, there's so many things that can happen. In fact, if you want to make this robust, you can also sensitize this revenue. And let's say, what if this cost is constant like this? Then this business does not get to generate up to this revenue within these 5 years. Right? Mr. Temitokwe, your video is on. Maybe you did not know. Okay, so we try and sensitize this. And we are saying, what if this business does not make up to this revenue within this 5 years period? how do you get to factor that in making necessary decision and be ready for things that can happen in your business, right? And that's what most people usually neglect whenever they are building their models. So as a modeler, whenever you are building your model, always make sure you test those impacts of different macroeconomic assumption. Another thing that we can also take a look at here is our quantity growth, right? Our quantity growth, we are saying yes, 12.5, 15, 10, and 16.8. What if get to the reality, right? And maybe let's say this third year, something happened in the economy. Definitely, we always impact, have effects on your business. Most startup businesses, yes, the last period was really great. The pandemic period was great. Let's say this is -10. How do you think this will affect the business? How do you think this will affect the business as a whole? Right? So the whole thing about this, you incorporating the macroeconomic factor is so that you understand that you're able to test your business against different macroeconomic that can affect a business as a whole, right? Because yes, if you've actually forecasted that this is how your revenue will grow, what if? What if? How do you get to sensitize that, create different scenario to be able to make that decision, so that you don't get to put the business, then you now start stressing the business out, and at long run it will eat on you, right? Then you realize cost is just increasing, revenue is not increasing the same way your cost is increasing, at least for the first 5 years. So, but if you've created this, it will be easy for you to have that negotiation, that conversation with your investors, right? If it's equity investors or if it's even loans, right? There are some loans where you can, they give you some grace period, maybe the first 2 years. All you are doing is you are just accruing, so they give you a moratorium period. So that kind of allow you to be able to plan and allow the business to grow with reality. So it's not a magic. So many businesses, they are shut and they've closed because of this, them not incorporating this. Financial modeling has got beyond you just putting values in Excel saying, yes, my price is this, in this next year, I will increase the price to this, I will increase the price to that. On what basis? Right? There are some things that really beyond your power. If anything, we have God's factor. If anything happened, like God's factor, for example, pandemic period, most business affected almost all the businesses. Those are the things that you should be able to factor in into your model, and that's why it is called financial model, so that to help you at least keep safe irrespective of anything that happened. But one thing I've realized is people just tend to neglect that. And you see a business telling you in year one making this revenue, then you see in year 5 you are seeing like 1 million. How do you expect that to happen? It's not a magic. Even if you be getting to that million, then the costs needs to also respond alongside with that, but it's always the other way around. So you see revenue growing, and you see costs just moving slowly. It does not work like that. So as a financial modeler, it's not about the number alone, right? The next thing is, does it make sense? You need to test it against different factors. What if inflation even increase more than this, right? What if our revenue, all right, for this one out, we decided to make our revenue grow, our price grow at 1%. What if we make everything constant and just make it 0? How will that impact our business? Right now, this guy, if this, let's say Mr. B even decided to keep his own pricing constant, right? So let me even adjust that. Let's look at this. So for this revenue, this guy, Mr. B, decided to make his own pricing constant. Let's look at that. And Mr. A is saying, I will increase my own price by 1%. Right? It's better this guy will be at the safer side. So by the time he gets to the reality of it, right, it's better, is able to generate more revenue and be able to manage this cost. That's the whole concept of modeling, is to help you make that decision so that you don't get to face it. Right? So by the time this man he only promised you 850, whereas this one is promising around something like 9 million plus. Definitely, by the time this man gets into the business and is able to even get the revenue of this guy, then it makes him a little bit relaxed and the business can grow very, very well without being under pressure. But this guy, right, he's already promised this kind of money. Then he gets to the business and is now saying the reality, revenue is not up to this, right? Cost is increasing as well. How do you now get to manage that? So that's the whole objective of this webinar, so that you are able to understand that yes, it's not all about you just putting values in Excel only, right? Let's help these business owners. Let's factor in things they don't think of that can actually affect their business as a whole, right? And I said one tool you can use is creating different scenario, creating different switches, and how they get to test this on their on their business model, and that's kind of give you that insight, either a startup, either a corporate organization. Those are that's how to actually approach a business concept, so that you are on the safer side, right? You are meeting investors, you are discussing, you're saying, oh, I'll give you this stake in my business with the profit sharing ratio of this. So everything needs to tie together, right? It's better, Mr. B, like this as an investor, you know that year one, year two, yes, this business might still will definitely be trying to navigate through the market. Then maybe from year three, right? I think we reduced that percent, right? From year three, they can now start pushing things up. So this this is how to think about business as a financial modeler, right? So we'll be rounding things up these points. Then if you have question, clarification, some further discussion, I will drop the mic so that our host can just address that. And as you're asking the question, I will also be giving us our responses. So thank you, Taiwo. I hope I can hand over the mic to you now.
Yes, thank
So
you.
to help us handle the question part.
Yeah, thank you, Victor. Thank you. So you have mentioned it's not all about the numbers. It's important that we help these business owners or startup founders to consider all of these macroeconomic variables or factors into their financial model or their business plan. Thank you so much, Victor. It's always an exciting time. It's always an exciting moment with you. So at this moment, we'll be taking questions, though we have a very short presentation, on insight, industry insight, and more of our competitive advantage. But for now, we would like to take any questions you may have for Victor with respect to the presentation so far. So please raise your hand, drop a message, unmute your mic, and then ask your question. Yes, the recording. Yes, go on,
Victor. Can we have the like sensitivity in this sensitivity in the modeling? Additional sensitivity means like this aggressive rate and conservative rate. Then means like we should have multiple row in the part of sensitivity, means like aggressive 100% or 75%, like that.
Exactly. I agree with you. You remember I mentioned that. So what he was asking is, can we have a sensitivity also built into this model and also see how that kind of impacts our revenue and profit? Yes, I agree with you. So maybe our next master class, I think we addressed that. So we continue from where you stop, and then we I will just teach us how to build. Number one, we've created one sample scenario. So how do you create scenario? There's something we also call scenario sensitivity, and then there's sensitivity on its own. So I think we'll do that in our next upcoming webinar. Yes.
Okay, thank you.
Yes, sir. That's a very valid point. Yes. Okay, Adeolu, your hand is up.
Adeolu, please.
Yes, sir. Good evening, everyone. Please, my question is this: can someone predetermine the profit that, okay, I just want my profits to be this figure, that how can someone model it using this inflation, microeconomic factor?
Sorry, can you rephrase that? I'm trying to get the question.
For example, maybe looking at this model, this scenario we just painted now, that okay, I just want the profit to be this amount. Maybe at conservative rates, I want the profit to be this. At aggressive rates, I want the profits to be this. So how can we apply this microeconomic factor to our modeling to be able to get that predetermined profits?
Okay, so what you are saying now is what we call forecasting, or more like budgeting. So you are saying my revenue, right? Maybe we have year one here, then let me just do this. So you have year one, then up to year 5, right? And you are saying, okay, everything being equal, right? You are saying we should be able to generate this revenue, right? You're saying you should be able to generate this revenue, and maybe you should be able to have this profit.
Yes.
Right, then you have those valued being set aside. Maybe you are saying 100 million, then here you are saying 250 and 350, right? The problem there is with this, and that's what makes modeling unique. And you're saying maybe profit you want to make 50, here you want to make 150, just like that. Now the problem here is this is what we call this is more like budgeting and ordinary forecasting of a thing, because when it comes to financial modeling, we believe all the line item in your model must have a very clean and clear driver, right? We want to be able to see what is driving this revenue, what is driving us to get this 100, what is driving us to be able to have this profit. So we want to be able to break everything down. For example, your revenue, you break down into what will be our price, what will be the quantity for a product company, right? For a service, you are saying number of jobs you get, how much are you charging per each job. So we want to be able to see that clean and clear picture. And that's how we can now see how does this specific factor, how does it affect this? So we are saying we'll be selling our price 20, maybe $20, $20. What are the things that can actually have impact on that $20? So we are saying, some macroeconomic, you go to the, you get to the market, you realize that someone has almost the same product and they are selling lesser than what you are selling. Definitely you need to, there should be an adjustment. If not, your product will just be there. So all line item must have a very clean and clear driver. So financial modeling is way beyond just saying, I want to make a profit of so, and we just leave it like that. No, we want to be able to see, this is the revenue, these are the components, these are your costs. We want to be able to itemize all those costs. What are your direct costs? What are your variable costs? What are your fixed costs? What are your salaries? What are those things that drives profitability? Right? Yes, if you generate more revenue, definitely you can have more profits. Revenue can increase and cost also increase, that the same. Then it leaves your profits not changing, and all those kind of things. So that's why it's always good to break things down, right? Component by component.
Thank you so much.
Right. So, and with that, it will be easy for you to now start factoring some scenario, different sensitivity, and the rest as well.
All right, thank you, Victor. So we'll continue with the presentation while you can still ask your question. Victor is still very much around to answer your question. So I have a few minutes to share with you some of the things that we have available as scenario opportunities we have at Scenario Academy. for you. But if you still have questions for Victor, Victor is still very much around to answer your question, as well as myself. So quickly, I just want to share with you how you can leverage on the expert experience that is available within the academy to basically turbocharge your financial modeling and business valuation expertise. So we have a program called Financial Modeling and Business Valuation for Corporate and Startup. So here is the curriculum of the program. So in case you are interested, you can reach out to me to know, in case you're interested in knowing who the facilitator of the program is. You can reach out to us personally and we'll have a conversation with you around that. But this is the component, or can I say the subject that are covered within the program, right? So both for corporate and for startups, we look at the component of revenue and costs. We look at advanced accounting and finance concept. We look at model build toolkit and forecasting factor. We look at model drivers and financial information, building out the three-statement corporate model build. Building a financial or a complete model from scratch. Investment evaluation ratios, where we talk about the margin and ratio analysis, WACC, free cash flow, terminal value, payback period, NPV, and a lot. So it's quite encompassing, right? So, and it covers both for startups as well as corporate organizations. So there are a lot of case studies that we're going to work on. We're talking about real life case studies using financial report of several organizations that and it's we can also share with you testimonials or people who have taken the program before, so you can learn about their experience and what they have gone ahead to do. I can even tell you we've had about 3 different organizations who actually asked us to refer people, not just to fill up an open role of a financial analyst, but also to even help them, especially startups, to help them to build a financial model for their startups. So there are a lot of opportunities available if you decide to be a part of this particular program. I am giving you 10% off should you be interested in registering between today and Wednesday. The program starts next Saturday, which is on the 12th of February. That's in another 2 Saturdays. So if you're interested, it runs for 5 weeks, Saturdays and Sunday, 5 p.m. to 7 p.m. If you go to scenarioacademy.com, you'll be able to register for the program. So this is one big opportunity for you, and I can guarantee you that at the end of the day, you would you will be happy with whatever the decision at the end of the day. So the next item I have here is, should you think you are already an expert in financial modeling like Victor that facilitated the program, we also have, or before I go into that, so this is our learning approach. It's pretty simple. It's a kind of mentored learning approach. And our class is designed such that it's more of an instructor-led, student-led training. Classes are live and interactive via Zoom. Let me even add that we also provide guidance if you eventually want to go for any of the certifications, right, like the FMI and the likes. Our classes are recorded, they are live recorded as well. It's because it's been done over Zoom, and the recordings are made available just immediately after the training. There are real application exercises, like I mentioned, that we'll be working on. Participant also, you can learn from participants from across other industries. Instructors are available and accessible 24/7 for, should you have any concerns or questions or challenges. Of course, the materials are quite easy to use, and also there would be a capstone project. So I'll just go ahead. Like I mentioned, if you feel you're already sound or a master of financial modeling, and one other area you may want to equip yourself with is data analytics. So beyond just finance, there's also a need to have a good grasp of the commercial analytics, right? So how is analytics driving commercial initiatives, right? Not just commercial, but also operations, removing operations, bottlenecks within operations. So how is analytics, helping to, provide insight on project in terms of maybe establishing new locations, opportunity assessments, and the likes. So this is not, you need not just only the financial model to tell you what decision the business should make, but also there are a lot of commercial, analytics or that can actually, influence business decisions, right? So Yax, you want to ask a question?
Yeah, please, can you go back to the last slide you just left?
This?
Yes. Okay, so thank you. I wasn't able to join this class early as I intended. My network is horrible here in Mina, Niger State.
All right.
Very, very horrible. So I just joined lately, but this is quite interesting, and I want to thank you for doing this. Thank you so much, and I look forward to getting engaged in the class.
All right then.
But here, the Excel we are using, I am a data analyst.
Yes.
But I am a computer scientist. I am not a financial expert, but I'm interested in business. I am interested in how all this works. So the Excel you're using is not Office 365, if I get that correctly, because I'm seeing VLOOKUP, index and match, and VLOOKUP, index and match, yeah.
I think whether it is of Excel is Excel, Office 365 is just more like a kind of license that you have to use Excel, right? So there are people who use Excel that are not Office 365. Maybe they are just maybe the normal license that you buy, or the the cracked version or whatever it is. But Excel is Excel. But our Excel in the data analytics class, especially the Excel class, is more of macros. So we build the material with macro and in macro, and so that it can actually make learning fun. So take, for example, now this is a macro, this is done in macro, and it allows you to show the answer to the question, just for you to validate whatever answer that you have, or correction, or whatever it is, exercise that you have done. So like I mentioned, whether it is Office 365 it's fine. Whether it is not Office 365, you are also welcome.
Yeah, I get it. The reason why I asked the question is because of VLOOKUP and index and match are quite complexes for some people. They are complex formulas for some people, how you do the matching and then crossing and then a whole lot of that. And then in Office 365, I know we have XLOOKUP, and then you have all these dynamic formulas.
HLOOKUP.
Yeah, it's even X actually. So it takes XLOOKUP, and then X as in X-ray. So which actually makes this very, very easy. Both VLOOKUP and index and match, which we don't need. But this is quite good. It's good people have the fundamental of VLOOKUP and index and match. So I'll be glad if the class can actually add that XLOOKUP, so that people can see that, okay, if you're interested in XLOOKUP.
It actually does. So it actually does. So this is basically, once you get to see the materials, you commit and you send the materials to you, you also get to see it.
Okay.
Yeah, unfortunately, this is an old material image that I'm showing you right now. But we definitely cover XLOOKUP and a lot more than what you can see here. If you look at this document, it doesn't have all of the preliminaries, right? Like all the referencing, name ranges. And so we start completely from the basics and then move into the intermediate, and then, you know, jump into a bit of an advanced features in Excel. So, so I think it's quite covered. Almost everything's are quite covered for you.
Okay. Thank you so much. I appreciate.
All right, then. Thank you. I think Hillary or somebody wanted to ask a question, or would you like to keep it till when I'm done with the presentation? Okay, so I'll just go on with the presentation. So in the case of our data analytics class, you have the opportunity to you know, enjoy a kind of bonus session where we dive so deep into data-driven strategies, or can I call it data-driven decision making, how several organizations, case studies of how several organizations have leveraged data analytics and how it has helped to drive initiative. I personally also will be available to share my experience. I have worked with the biggest airline in West Africa for 7 years as a business intelligence analyst, and corporate strategist, and also I've moved around FMCG to healthcare. So so then also another opportunity is that 3-month post-training internship that you also get to enjoy in our data. It's a remote free internship though, and then our alumni group. So like I mentioned, if you're interested in the data analytics and track as well, these are some of the things that you get to see from basic to advanced. So a couple of basic things that will help you to understand that you need to do as a data analyst, you know, for the organization in terms of categorizing the business data across channels, markets, you know, distribution channels, you know, market channels, market segments, product segments, tracking their growth of each of those items month on month, year on year, and, you know, looking at identifying the growth drivers as the revenue drivers and the likes. So, and then we move into a bit of an advanced that talks a lot about sensitivity, 80-20, basket analysis, how some of these advanced concepts in data analytics can, you know, our organizations leverage on them to make, you know, sincere and very fine business decision. So, so this is the schedule of our program for the data analytics. Apparently, the physical class we started yesterday, we started today, but for the online class, it's starting next week, while the financial modeling class starts on the 12th. So on the 12th. So this is the online class, meaning that you can join the class from anywhere. It starts from 4:30 p.m. to 7 p.m. and next cohort starts next week, Saturday. It runs for 8 weeks, Excel, SQL, and Power BI. So this is, you know, I mean, I can tell you that it is an opportunity to jump on, right? It's a huge opportunity to jump on right now. Then we also have the data science class. And should you also be interested in data science? You know, there are a lot of things that most financial guys who are into financial analysis in organizations are beginning to, you know, get skilled in data science, and you know, there are a lot of people in banks who are, you know, leveraging data science to build recommendation system, you know, build solutions that help the banks leverage on people financial behavior to allow them to access loans and the like. Really sorry, guys. I think I lost internet. So so I'll just rush through this, right? And so I think I'll just rush through this. So then we have the physical class. So you can get details about all of these on our website, scenarioacademy.com. But back to the main business why we are here today. while we are also open to take more questions, this is just to buttress again on the financial modeling and business valuation program that is starting on the 12th of February 2022. I have mentioned here, you can see the prerequisite is have a knowledge of accounting, finance, and Excel. The cost is 80,000, but you have the chance to leverage on we call it a Victor's discount. So you can take advantage of the discount right now, meaning that if you register on our website and you provide this SAMSCL discount code, you get to enjoy 10% off. So Benga, do you want to ask the question?
Yes, thank you. I think you just somewhat answered my question. I wanted to confirm if the 80,000 already includes or already factored in the 10%, or the 10% is net of the 80,000.
Yeah, so the 80,000 is the actual fee. So if you use the code, you get a 10% off the 80,000. So that means you get to pay 72,000. But mind you, this code expires by Wednesday. Yes.
Thank you for that.
All right.
Thank you.
All right. Adeolu.
Yes, sir. Hello.
Yes, go ahead.
So the payment, is it through the website, through your website?
Either of both. So once you register, you see the option to pay online through Flutterwave, or you can decide to reserve and do a transfer.
Okay.
Yeah, so if you reserve to do a transfer, you get an email in your email, and in your email box, it will contain all of the details you need. If you don't get an email, check your spam box or reach out to us. We have our number, our WhatsApp number on the site.
Okay.
Yeah.
Thank you, sir.
Yeah. So guys, I wish I am able to show you most of the testimonial of our students in the last session. And should you also are still skeptical and you would want to hear, you can reach out to me personally, can give you more details, also give you more references, and give you, like I mentioned, Scenario Developers is a consultant to a couple of organizations, right? And I can start mentioning their names. To a consultant to SynLab. SynLab is a global healthcare diagnostic center. Same with Afri Global. We are consultant to two of the 5 biggest airlines we have in Nigeria. And a couple of other FMCGs. So it will really be an opportunity for you. This is something you will never find anywhere else. And I can tell you that, and I can beat my chest to tell you that. Apparently, this dollar value is not correct. Please disregard it. The dollar value is 143. So please disregard that. On the website, you see the correct value there in case you're trying to pay from outside of Nigeria. So join the train and take advantage of this. It's a huge opportunity, and I can tell you have a time of your life. So we are open to questions. If you have more questions, if you have questions for me, for Victor, let's just take it so we can round up. Yeah, Emmanuel, please go ahead.
Okay, thank you, Victor and the host, for this very great section. I'm very well impressed and I've learned a lot as a person. But then I would like to ask that, for instance, for the financial modeling and business valuation, one of the prerequisites is accounting, Excel, and finance. For me, I'm not into accounting, I'm into construction, but we do a lot of finance there. So I don't know what's the prerequisite for. I'm more interested in the data analytics, starting from basic to advanced. So I don't know, what's the prerequisite for that?
Okay, so I don't know, maybe I'll let Victor start and maybe take something with respect to the initial question that has to do with a prerequisite for financial modeling and business. Victor, do you want to say anything about that? Or would you like to say anything?
Okay, I think she's referring to the, she says she's more concerned with the analytic part, right? For the financial modeling, these three skills are very important that you have it to just make it seamless for you. Accounting is a must. Excel knowledge and finance, at least, even if you still, at least that Excel and finance can still be taught during the training, but that accounting part is very necessary. You don't need to be an accountant guru or certified like that, but the other thing is you should still be able to create a simple three financial statement, and you understand how that kind of link together.
Okay, thank you, Victor. So with respect to the prerequisite for the data analytics, it's a, you don't have to know anything. We start from the scratch, the basics. I can tell you the basics is like saying, because the courses, the modules include Excel, SQL, and Power BI. So we start with Excel, which we know that you probably have been working, and we start from the beginning of Excel, right? Helping you to understand, a lot of the basics, like the referencing, how to, all those proper sum and the like. So logical conditions, arithmetic conditions, and arithmetic statements and the like. So before we move into the intermediate, as well as the, we touch on the advanced as well. So we've helped a lot of lawyers to transition, customer care agents to transition into data analytics. So I can tell you that you really do not have to have any background, except for the fact that you have a computer or a laptop and you know how to use it. That's all that is required.
Okay, thank you. I think it's fine now. I can get it better.
All right, thank you. So Yax, do you want to ask a question?
Yes.
Right.
For the what is it called? The data science.
Yes.
Is there any specific reason why you choose Python maybe over R?
Okay, so
and for the Python you are choosing, what are the packages you are using? Panda and then all that. I'm actually interested in that very particular one.
Okay, so let me scroll down there. So basically, Python, one of the reasons why we chose Python is one, it is the most adopted language for data science, right? Beyond that, Python does not restrict you only to data science, because when we start data science class, we're going to do a bit of a crash course on Python, right? Because Python is used for game development, application development, artificial intelligence, and the like. So meaning that your knowledge of Python is not a waste, meaning that you can easily, unlike R, that basically restricts you to more data science and analytics. Python, it's something that with the knowledge you can easily diversify as well to other areas of like game development, application development, and the like. So beyond that, I mean, if you go to, there's a platform called Stack Overflow, right? And they do a kind of yearly survey of thousands of developers across the world. And I think for the consecutive 5 or 6 years now, the most, used, most loved, and how do I put it now, programming language is Python. So it's really
most popular.
Say again.
The most popular.
The most loved, most popular, and then most wanted, right? So if you go online and search for Stack Overflow developer survey and go to the technology section, you see most loved, most wanted, and the like. So it's actually a no-brainer, right? To say you want to choose R over Python. A lot of people also do R, but the idea is that Python, gives you a bit of flexibility, and you can as well diversify easily with your knowledge of Python. And then when it comes to the library, you can see them. Every library that you need to start the machine learning module is going to be taught during the Python for Data Science module. After the crash course, we'll explore NumPy for numbers, pandas, for data manipulation, and we'll explore Matplotlib for the charts and the graph, as well as Seaborn, a bit of web scraping before we now move proper into building machine learning models. And then in the model, we look into a lot of regression techniques like linear logistics, and the likes, as well as some other machine learning models like K-means, clustering, and the rest. And the interesting part is the projects that we work on, right? So you look at the driver, rider delivery time analytics, customer segmentation analytics, digital lending. Like I mentioned, it's a no-brainer. Almost, if you ask any data scientist, they will tell you as part of your portfolio, you should work on something related to digital lending, model, because vast amount of the lending platform leverage on machine learning model to, determine whether a person that wants to take loan is eligible or is capable of paying back, right? So I hope that answers your question, Yax.
Yes, it does. It does. Thank you so much.
Thanks a lot. Yeah. Any more questions before we close out? Any more questions in the next couple of 5 minutes? If you have more questions, we can take. Otherwise, we can close out. Okay, I think there is no more question. So in the absence of no question, I want to thank you so much, Victor. Thanks for coming. Thanks for joining us. Thanks for always accepting our invitation. We hope that we can do this again another time. Thanks everyone for joining in. It's been a great time with Victor today, and we hope to see you. We are open to receive any of your inquiries and questions. We can reach out to us through our website, scenarioacademy.com. And that will be all. Have a wonderful day. Enjoy the rest of your weekend.
Thank you so much, and stay blessed.
Yeah, you too. Bye.